Most high-income earners with investment properties are doing what they think they're supposed to do. They bought the rental, they're claiming depreciation, and when you look at the property, on its own, everything looks fine. But when you step back and look at how the property fits into the rest of their tax picture, they're only capturing a fraction of what real estate is capable of providing them from a tax perspective. And I see this almost every week. People making $500,000 a year, $1 million, $1 million plus, who own investment real estate and on paper are doing seemingly everything correct. The property cash flows, they're taking depreciation, and they've got it in an LLC. But when you actually step back and you look under the hood, how much depreciation is being captured, what type of property it is, and how it connects to their overall tax strategy for the long play, the gap between what they're currently saving and what they could be saving is often one of the most expensive gaps, and they don't even know it. Real estate is one of the only asset classes in the tax code that can generate significant losses, meaningful enough to actually offset your W-2 or business profits. And once you start looking at it that way, everything about what you do with your depreciation, what you buy, and how you think about the long-term benefits will change. I'm Ryan Carrier, I'm a CPA who helps high-income earners use real estate tax strategies to cut their tax bill. And in this video, I'm going to walk you through the 3 shifts that happen once you actually understand the benefits that real estate can have on your tax bill. Let's walk through what actually changes. The first thing that changes is how seriously you treat your depreciation. Because at some point, claiming the standard deduction on your rental property starts to feel less like a reasonable approach and more like a real measurable cost. I'll often sit down with people in their 30s or 40s or 50s who have high incomes, own a rental property, and haven't made any obvious mistakes at the surface. And when you walk back through the last several years, the pattern starts to make sense. Like most investors, they'll buy a rental property, figure out their building basis, and depreciate that straight line over 27.5 or 39 years, and never think about it again. Their CPA puts it on the return, they got a modest deduction, and that's it. It never feels like a mistake because something at least is being claimed and they know that they should. But I had one client recently who was getting a cost segregation study quote from multiple vendors. They showed that without a cost segregation study, they were going to receive $12,000 of depreciation, but with a cost segregation study, they were going to receive over $400,000 of depreciation in the first year. But for most people, when you're just claiming straight line depreciation, there's nothing that feels like a moment where you found there was a mistake. The depreciation was being claimed every year and everything seemed fine. But the gap between what they could have had and what they have been claiming was slowly building in the background of what the potential value could have been. And if I were to compare someone who bought the same property, the same income, the same purchase price, between someone who did not do a cost segregation study and someone who did, the amount of potential deductions is obvious. And even by year 5, the differences are very significant. And especially when you evaluate the time value of money of what those dollars could have generated in terms of wealth for you. And that's kind of where the shift happens. It moves from, hey, this is something my CPA calculates for me on my tax return for my depreciation schedule, to something that can actually be a differentiator and a strategic decision of whether you do a cost segregation study and how you handle your depreciation. And by the way, closing the gap on some of this and helping my clients understand what's going on is exactly what I do at Carrier Tax Consulting. I sit down with high income earners, look at what their real estate is actually doing for them, and show them where they have missed opportunities or where they're headed to potential benefits. If you're curious of what that potential benefit could be for you, the link to book a call with me is in the description. All right, now let's talk about what else changes. The second thing that changes is what you actually buy. This is where a lot of the opportunity really sits. Because when I look at a client's real estate situation, it's not usually that the investment itself is bad. It's most likely cash flowing, it's appreciating, they're getting some debt pay down, and on the surface, everything looks reasonable. But very often the property type, the purchase price, or the entity structure limits how much the strategy can actually benefit them for reducing their taxes. So let's talk about long-term rentals versus short-term rentals. A lot of high-income W-2 earners own long-term rentals because that's kind of what they heard on BiggerPockets or Instagram or TikTok, whatever it might be. Long-term rental losses are passive by default and generally can't offset your W-2 or business profits unless you meet something like real estate professional status, which is harder for most people to meet. But a short-term rental with material participation can generate significant losses to then offset your W-2 or business profits. Again, as long as you meet all the requirements for the short-term rental strategy, which is the average stay is less than 7, and you materially participate in that property. Point is, it doesn't require the extra hours that real estate professional status does, like the 750 hours and the more than 50% of your time test. So two investors with the same income, same property purchase price, but different property type, a long-term rental versus a short-term rental, most of the time the short-term rental investor is going to get a much greater tax benefit as long as they meet the short-term rental tax strategy requirements. And it's not because one property is better or nicer. It's that the IRS and our lawmakers allow the tax treatment to be different under the IRS regulations. So let's say we have a high-income earner making $500,000 a year, and that might be you. What's the difference between you buying a $400,000 property and a $1.2 million property? The depreciation difference is pretty dramatic. Because the purchase price is 3 times more, you're generally going to get 3 times more bonus depreciation. A good simple rule of thumb is to take about 20% of your purchase price is going to be your bonus depreciation in the first year. So for a $1.2 million purchase, you could be looking at $240,000 of losses to offset your W-2 income. But here's the thing, the time commitment is almost going to be the exact same, because either one you're going to shoot for usually the 100 hours and more than anyone else test. So you might get 3 times more in depreciation and put in the same amount of time whether you bought a $400,000 property or a $1.2 million property. For someone with a $500,000 income, going with a $400,000 property isn't bad at all. It just might not feel like it was completely worth their time and effort because of the investment at stake, the time that they put in, and what they were trying to accomplish with meaningfully reducing their tax bill. Most investors either hold a property in their own name or throw it in a single LLC and call it done. That's okay, but there's more to consider there in terms of a holding company or a trust and how that could impact you from a tax filing perspective and ongoing fees as well. The structure itself isn't going to save you taxes today, but it can protect you. And when this is missing, it starts to expose some of your liability. And this is some of the shift. Instead of asking, should I buy a rental property? It becomes, which property type benefits me the most? And how should I structure this as strategically as possible? The third thing that changes is how you think about taxes beyond just the first year benefit. Because most people think about real estate tax strategies as a one-time, one-year play. They buy the property, they get the big deduction, and then they kind of stop thinking about it, or they just do it once and they say, that was great, let's go do something else. But the most successful plans and clients I've worked with usually do this on an annual basis. And they're thinking about what happens in year 2, year 3, year 5, year 10, year 20. And eventually, what's going to happen when they exit. So yes, year 1 is typically where the big savings are going to happen, especially with cost segregation study and bonus depreciation. But you don't get 0 depreciation in year 2 and onward. It continues to produce deductions for you year after year until it's completely used up. But the question is whether those deductions are being fully maximized or just kind of forgotten about. And keep in mind, if you buy a property every single year, which is what I'm talking about, you will get new losses every single year. The benefit is significant in the first year. And so if you want to see those benefits on an annual basis, you're looking to buy a new property every year. And as you continue to acquire more properties, you being able to group them together is going to allow you to scale by acquiring more properties, which is going to mean more cash flow, more appreciation, more debt pay down to build your wealth and equity, but also can mean that you can keep your hours at 100 hours and more than anyone else for years and years and years to come. So you could keep your hours the same, but grow your wealth and your cash flow and your tax savings significantly over time. Now, if you do decide to sell the property in the future, you've got capital gains and you've got mostly depreciation recapture. The more depreciation you've taken, and obviously there's going to be more if you do accelerated depreciation, the more that you'll eventually have to pay back. This doesn't mean that cost segregation studies are a bad decision. It means that you just have to be strategic and remember what your goals are now and what your goals are in the long run when you exit. Options like 1031 exchanges can entirely defer the full gain that you might have, but they have strict rules and time requirements. If you hold real estate for your whole life, you can allow your heirs to get a step up in basis to permanently remove any tax liability associated to that property. We call this the defer, 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 die strategy. And yes, it's a very long play and very few can actually pull it off, but it has huge generational wealth advantages. to transfer to wherever you want to, whether it is your heirs and kids, charities, wherever it might be. So you've got people who are like investor A, who buy a long-term rental, they take the standard deduction, and then they go to sell it in 5 to 10 years because it doesn't work out very well, and they're shocked by the depreciation recapture. Or you've got people like investor B, who consider doing a cost segregation study to maximize their depreciation. They're strategic in what they bought because they bought a short-term rental and materially participated to offset their W-2 or business profits. And then they think about when they're going to sell in several years, whether they want to do a 1031 exchange or a 1031 light, and how they're going to minimize the tax liability on the sale. Same property value, same original strategy to buy real estate to build wealth, but one planned ahead and thoroughly maximized their benefit of real estate, and the other was just nonchalant about it. And real estate stops being a one-time strategy and starts being an ongoing plan that evolves over time with your income, your portfolio, and your goals. And hopefully this is now all coming together for you, because when you adjust how you treat depreciation, what you buy and how you structure it, and how you plan for the long game, the tax picture that shows up now and every year moving forward can be significantly different. On paper, two high-income earners can arrive at the same point with similar properties with similar outcomes, but when you actually look at how their tax plans function over time, they can feel completely different. And so the way to think about this is pretty simple. Real estate is one of the most powerful tax tools in the tax code for high-income earners, and most people know that. But what I see more often than not is that people don't execute on it appropriately, and it's not fully built into their plan with a thorough process and strategy. And over time, that shows up in ways that are easy to miss, but hard to ignore when you look back 10 to 20 years from now and see all the benefits and opportunities that you missed out on. Now, everything that I covered here is a big picture of how to think about real estate and taxes. And if you enjoyed this video, I hope you'll give this video a thumbs up, and I'll see you in the next video.